The modern banking system, with its central banks and credit cards and electronic transfers, feels like a product of industrial capitalism, something that emerged with factories and stock markets in modern finance. But the truth is that sophisticated banking existed centuries earlier, and the most advanced financial system before modern times wasn't in London or New York, but in medieval Italy, particularly in Florence, Venice, and Genoa, and it wasn't run by governments or nobility but by merchant families who invented techniques we still use today: double-entry bookkeeping, letters of credit, bills of exchange, foreign currency trading, deposit banking, even something approaching insurance and futures contracts. And these innovations weren't academic exercises. They financed the Crusades and international trade, funded kings and popes, built cathedrals and city-states, and made certain families, particularly the Medici, wealthier and more powerful than most monarchs. But this medieval banking system operated in a strange legal and moral landscape. Because Christianity forbade usury, the charging of interest, which meant that banks had to disguise what they were doing, hide interest as exchange rate fluctuations or service fees, create elaborate fictions to make lending look like something other than lending. And this tension between economic necessity and religious prohibition shaped medieval finance in ways that seem bizarre today, but actually reveal something profound about how financial systems emerge and evolve, how innovation happens in the cracks of legal and moral restrictions, and how the people who figure out how to make the system work, even when the system officially prohibits what they're doing, accumulate enormous power and wealth. The usury prohibition came from multiple sources: the Old Testament, Deuteronomy 23 verse 19, "You shall not charge interest to your brother." The New Testament, Luke 6 verse 35, "Lend, expecting nothing in return." And later canon law, which forbade Christians from charging interest on loans. The penalty was excommunication, denial of Christian burial, invalidation of the contract. This wasn't a minor rule. It was a fundamental moral teaching. Interest was seen as unnatural, as making money from money, rather than from labor, as exploiting the poor who needed loans for consumption rather than investment, as violating the natural order where things produced fruit, like trees and animals, but money was sterile and couldn't naturally reproduce, so charging for its use was somehow stealing from time itself, which belonged only to God. These arguments seem strange to modern ears. We think of interest as the time value of money, the natural compensation for lending, but medieval theologians saw it differently. They distinguished between productive investment, where a merchant puts capital into a venture and shares the risk, which was acceptable, and pure lending at interest, where the lender takes no risk but extracts guaranteed return, which was usury and forbidden. And this distinction created the space where banking could develop, because if you could structure a transaction as investment rather than lending, as risk-sharing rather than interest, then it wasn't usury and clever. Bankers spent centuries figuring out how to do exactly that. The simplest technique was the bill of exchange, which worked like this. A merchant in Florence wants to buy wool in England, but doesn't want to transport gold across Europe, dangerous and expensive. So he goes to a banker and deposits florins. The banker gives him a letter instructing a correspondent in London to pay pounds to the merchant or his agent. The merchant travels to London, presents the letter, receives pounds, buys wool, brings it back to Florence and sells it, then returns to the banker with a letter from the London correspondent confirming payment, and settles the account. Now the genius is in the exchange rate. The banker might agree to exchange 100 florins for 20 pounds when the merchant deposits the money, but when settling the account months later, the rate might be different, might now be 105 florins for 20 pounds. So the merchant owes the banker 5 extra florins. And this 5 florins is effectively interest, compensation for the time the banker's money was tied up. But it's disguised as foreign exchange fluctuation. And since exchange rates really did fluctuate, and since determining the correct rate was complex and involved judgment, there was plausible deniability. The banker wasn't charging interest, he was just changing money at different rates at different times. And who's to say what the correct rate should be? This fiction satisfied the church enough to allow bills of exchange to proliferate. They became the dominant mechanism for long-distance trade and credit, and the bankers who operated them, who had correspondents across Europe, who could be trusted to honor letters of exchange, who understood the complex web of rates and timings, these bankers became indispensable to commerce and accumulated enormous wealth and power. Deposit banking emerged similarly through circumventing usury rules. Merchants needed a safe place to store money, better than keeping gold at home, where it could be stolen. So they'd deposit it with a banker who had a secure vault. Initially, this was pure safekeeping. You deposited 100 florins, you could withdraw 100 florins, the banker charged a fee for the service. But bankers realized that most depositors didn't withdraw all their money at once, that there was always a pool of deposits sitting in the vault, and this money could be lent out, put to productive use, as long as enough remained to meet withdrawal demands. This was fractional reserve banking, the discovery that you could lend out more than you had as long as not everyone wanted their money simultaneously, and the profit came from lending out deposits at a higher rate than you paid depositors. Except you couldn't explicitly pay interest to depositors because that would be usury in reverse, the depositor receiving interest. So instead, banks offered services, free money transfer, commercial intelligence, access to credit, and these implicit benefits compensated depositors enough that they accepted zero explicit interest, or banks would find ways to disguise interest as something else: rent on property, dividend from a partnership, share of profits from a venture. The form mattered more than the substance. As long as it didn't look like pure interest, as long as the fiction could be maintained, the system could work. The great banking families emerged in the Italian city-states because these cities had unique conditions that enabled financial innovation. They were merchant republics, governed by commercial interests rather than hereditary nobility. They had extensive international trade networks. They had relative political stability and rule of law. They had accumulated capital from Mediterranean trade. And they had religious permission through various loopholes and papal exemptions. The church itself needed banking services to collect revenues from across Europe and finance its activities. So it tolerated certain banking practices even while officially condemning usury. This created a symbiotic relationship where the church used banks while denouncing them in principle, and the bankers genuflected to church teaching while ignoring it in practice. In certain cities, particularly Florence, became banking centers where expertise accumulated, where techniques were refined, where trust networks developed, and where families specialized in banking over generations, learning the business from childhood, building relationships across Europe, understanding both the technical aspects of exchange and credit and the political aspects of dealing with kings and popes and city governments. The Medici were the most successful of these banking families. They didn't invent banking, but they perfected it. They understood that banking was as much about information and relationships as about money. They built a network of branches across Europe, each staffed by trusted agents who were often family members or long-term employees. They developed sophisticated accounting methods to track the complex web of transactions across branches. They understood risk management, diversifying their activities across trade, manufacturing, and banking. They cultivated relationships with popes and kings, becoming bankers to the papacy, which gave them legitimacy and access to the church's vast revenues. They lent to monarchs, which was risky because kings often defaulted, but when it worked it gave them political influence and commercial privileges. They were patrons of arts and architecture, commissioning works that enhanced their prestige and the glory of Florence. They entered politics, eventually becoming de facto rulers of Florence while maintaining the republican forms. And at their peak in the mid-15th century, they were arguably the wealthiest and most powerful family in Europe, not through noble birth or military conquest, but through financial skill, through understanding money and credit and how to make them flow in profitable directions. The techniques medieval bankers developed were genuinely sophisticated double-entry bookkeeping, invented in Italy in the 13th or 14th century, recorded every transaction twice, as a debit in one account and credit in another, ensuring that the books always balanced. This seems obvious now, but it was revolutionary. It allowed businesses to track their financial position accurately, to spot errors, to understand profitability across different activities, and it transformed accounting from record-keeping to management tool. Merchants could now make informed decisions about which activities to expand and which to curtail, and banking families could manage complex operations across multiple locations. The Medici Bank used double-entry bookkeeping across all its branches, with periodic reconciliation, and this gave them an information advantage over competitors who used cruder methods. Insurance developed as another way to manage risk while avoiding usury. Prohibitions. Merchants sending ships to the Levant faced risks of storms, pirates, shipwreck, so they'd find investors willing to take a share of these risks in exchange for a share of profits. These maritime insurance contracts were structured as partnerships or conditional sales rather than as loans, but they functioned as insurance, spreading risk across multiple investors, and the premiums, disguised as profit shares or price adjustments, compensated investors for bearing risk. This was actuarial thinking, understanding that losses could be predicted statistically even if individual incidents couldn't, and that proper pricing could make risk-bearing profitable. The system's sophistication extended to government finance. Medieval states needed to borrow, to finance wars or construction or just to smooth out tax collection. But they couldn't explicitly borrow at interest, so they issued bonds disguised as forced loans or voluntary contributions. The Venetian Republic issued prestiti, forced loans from wealthy citizens, supposedly interest-free but actually paying implicit returns through tax exemptions or political privileges. These prestiti traded in secondary markets, becoming something like modern bonds. With prices fluctuating based on Venice's creditworthiness, investors could buy them speculatively, and Venice could effectively manage its debt by buying back prestiti when prices were low. The Florentine Republic did something similar with money bonds, and these government debt instruments, which couldn't officially bear interest, developed yields and prices that reflected risk and time value of money, just like modern bonds. The fiction of no interest had become so elaborate that it barely constrained the reality of sophisticated debt markets. The international dimension of medieval banking was crucial. The system only worked because it was international, because bills of exchange required correspondence in multiple cities, because the disguise of interest as exchange rate fluctuation required actual foreign exchange, because diversification required operations across multiple jurisdictions. And this internationalism gave bankers a form of power that transcended any single state. A Florentine banker with branches in London, Bruges, Venice, Rome, and Lyon couldn't be completely controlled by Florence because he had alternatives. He could shift operations, move capital, place cities and monarchs against each other. This was early financial globalization, and it gave banking families independence from political authority that was unusual for their era. They weren't exactly sovereign. They couldn't field armies or pass laws, but they weren't exactly subjects either. They were too important, too connected, too capable of causing problems if crossed. And this ambiguous status, neither ruler nor ruled, but somehow essential to both commerce and state. This was something new in European society, a form of power based purely on financial skill and networks rather than on birth or military force. But the system was also fragile. Banking families could be destroyed by bad loans, particularly loans to monarchs who defaulted. England's Edward III defaulted on loans from the Bardi and Peruzzi banks in the 1340s, bankrupting both and causing a financial crisis in Florence. The Medici Bank gradually declined in the late 15th century, partly from bad loans to Charles the Bold of Burgundy. Lending to princes was lucrative but dangerous. They could default with impunity, and recovering debt from a monarch was nearly impossible. Banks also faced the risk of political changes. A new government might confiscate assets, cancel debts, expel bankers. The Jews had done much medieval lending, since Christianity's usury prohibition didn't apply to them. But they were periodically expelled, their property seized, their loans canceled, and Christian bankers faced similar, if less extreme risks. The Medici were expelled from Florence when the Republic was restored, returned when the Medici became dukes, but their banking operations never fully recovered, and the structure of disguised interest created constant tension. If the disguise slipped, if a loan looked too much like usury, the church might act, declaring the contract invalid, excommunicating the banker. This didn't happen often, but the threat existed, and it meant medieval bankers operated in a legal gray area, technically violating religious law but protected by fiction and necessity. The deeper instability was structural, fractional reserve banking, which medieval bankers practiced even without fully understanding it, is inherently unstable. It works as long as depositors don't all want their money at once. But if panic hits, if rumors spread that a bank is in trouble, depositors rush to withdraw. The bank must liquidate assets to meet withdrawals. Asset prices fall. The bank's solvency deteriorates. panic spreads to other banks, and the system can collapse. Medieval banking saw periodic crises that look remarkably modern: bank runs, liquidity crises, contagion effects, and there was no lender of last resort, no central bank to inject liquidity, no deposit insurance to prevent runs. So banks had to rely on reputation and relationships. A bank with strong reputation could survive temporary liquidity problems because depositors trusted it. But reputation was fragile, could be destroyed by rumor, and once lost was almost impossible to recover. This meant medieval banking was always precarious, always one panic or default away from collapse. And many banks did collapse, taking depositors' savings with them, creating hardship and anger and periodic demands for regulation or prohibition. The moral tension never fully resolved. The church continued teaching that usury was sin while tolerating the fictions that allowed banking. And this hypocrisy created cynicism. People saw that the rules applied differently to the powerful, that bankers could violate usury prohibitions through clever structuring, while poor people who charged interest openly faced punishment. This contributed to periodic anti-banking sentiment, denunciations of bankers as bloodsuckers and usurers, occasional violent reactions, and persistent moral unease about whether banking was legitimate. Were bankers providing a necessary service, facilitating trade and economic growth, or were they parasites, extracting wealth without creating value, exploiting others' necessity? The medieval period never answered this question definitively. Different thinkers and movements answered differently, and the tension persisted into the Reformation, when Protestant attitudes toward interest began changing. Calvin eventually declared that reasonable interest was acceptable, that the usury prohibition applied only to exploitative rates, not to fair commercial lending, and this theological shift would enable the development of modern banking in Protestant countries. But even today the question remains, is finance productive or extractive? Does it serve the real economy or exploit it? And the medieval struggle with this question, the elaborate fictions invented to reconcile financial necessity with moral prohibition, reveals something fundamental about the ambiguous status of finance in society. The legacy of medieval banking is everywhere in modern finance. The techniques they invented, double-entry bookkeeping, bills of exchange which evolved into checks and wire transfers, letters of credit, foreign exchange markets, deposit banking, risk management, these are all still used, refined and elaborated, but fundamentally similar. The organizational forms they developed, branch banking networks, correspondent relationships, partnerships, and companies, these became templates for modern institutions. The moral questions they grappled with, about the legitimacy of interest, about whether finance creates or extracts value, about how to regulate banking to prevent abuse while allowing necessary functions, these remain contested, and the basic insight that financial innovation happens in the cracks of regulation, that people find ways around restrictions when economic incentive is strong enough. This is still true. Shadow banking and derivatives and cryptocurrency, these are modern versions of bills of exchange, ways to do financially what's prohibited or regulated if done directly, creating fictions and structures that achieve the economic purpose while technically complying with or evading regulation. The medieval bankers would recognize the pattern even if the specifics are different. The secret banking system that ran the Middle Ages wasn't really secret. Everyone knew it existed, knew that Italians were financing trade and lending to kings and collecting papal revenues. What was secret, what required elaborate fiction and misdirection, was that they were charging interest, that behind the complex structures of bills of exchange and partnership agreements and foreign exchange fluctuations, behind all the legal and theological gymnastics, they were doing exactly what the church said was forbidden. They were lending money and taking interest, and everyone knew it, but nobody could say it. The church knew, but looked away because it needed banking services. Kings knew, but didn't care because they needed loans. Merchants knew and were grateful because bills of exchange were far better than transporting gold across Europe, and the bankers themselves knew, were quite clear-eyed about what they were doing, but maintained the fictions because fictions allowed the system to work. This was hypocrisy, but it was functional hypocrisy, the kind that allows society to operate despite contradictions between rules and needs, between moral ideals and economic realities. And maybe that's the deepest lesson, that financial systems, medieval or modern, always involves some disconnect between how they're supposed to work and how they actually work, between the official rules and the practical realities, between what we say about finance and what finance actually does. And the people who understand this disconnect, who can navigate the space between rule and reality, who can make the system work while maintaining the fictions that allow it to work, these people accumulate power and wealth. Whether they're Medici bankers structuring bills of exchange to hide interest, or modern bankers structuring derivatives to minimize capital requirements, or cryptocurrency entrepreneurs structuring tokens to avoid securities law, the pattern repeats. Innovation happens in the cracks. And the secret banking system, whether medieval or modern, isn't really about technology or techniques. It's about understanding that the official system and the real system are different, and knowing how to operate in that difference. That's where the opportunities are. That's where the power is. And that's what the medieval banking families understood 500 years before modern finance. They'd figured out the basic truth that finance is always partly illusion, partly fiction. Partly a game of structuring reality to fit categories that allow it to be acceptable, and that the people who master this game, who can make the fictions convincing while serving real economic needs, these people become indispensable, too important to punish despite technically breaking rules, too necessary to the functioning of commerce and government to be dispensed with. And so they accumulate wealth and power and influence that transcends their formal status, just as the Medici went from merchants and bankers, theoretically humble commercial roles, to de facto rulers of Florence and power brokers of Europe, all through understanding money and credit and how to make them flow, through understanding the secret banking system that everyone used but nobody officially acknowledged, the system that ran the Middle Ages as surely as central banks and credit cards run our economy today. Different in form, but fundamentally similar in function, creating credit, facilitating exchange, concentrating power in the hands of those who understand the system's inner workings, and demonstrating that banking, whether medieval or modern, is always as much about relationships and information and navigating social and legal constraints as it is about money itself.